Good morning, everybody, and thank you for joining us for what is the final Balanced Perspective of 2021. Absolutely thrilled that Iain Power is joining us face-to-face in the studio for the first time in almost 2 years, Iain.
That's right, David. It's a bit of a shock, but I'm here in Cape Town, and it's great.
I don't know whether to be more excited the fact that work travel is back on, or whether it's a sad indictment that seeing you in person is the highlight of my year so far. But welcome to Cape Town, and it's great to have you in the studio. I must say it feels quite strange almost talking to you side to side, but we won't forget about the audience on the screen here. The title for today's session was Through the Looking Glass, so a little bit of a play on Lewis Carroll's Alice in Wonderland, and we said 2019 has very much been a rabbit in the whole year, and at least 2020 and 2021 has been the world's re-emergence. And over the course of the last year, Iain and I have touched on numerous topics, and I'd like to go back and revisit maybe those which are still prevalent today and have some meaning as we move into 2022. So Iain, going to the first question, back in April, we discussed US Treasury rates. I think they bottomed out at about 60 basis points. To your credit, you said they would peak up above 100. They went to about sort of 130 and 160, been hovering around there. Back then, you also made the potential call that will go above 200 basis points going into Q1 or Q2 next year. Maybe just to remind us why the risk-free rate is so important in investing, and then how you might see these rates playing out over the course of 2022.
Yeah, thanks, David. And I think it's an important rate, I guess, to understand the direction of travel, because the US long-term interest rate is effectively the base rate that most interest rates around the world use as a reference point in terms of the implied interest rates in whatever country we live in. So I think, why is that important? It's important because ultimately this forms part of the building block of an interest rate in wherever you are in the world that is used to discount the future cash flows for companies, and where we use that to arrive at what is an intrinsic value. So, if rates go down, typically what you find is long duration assets, whether they be bonds or equities, especially the growthy type equities, get lots of multiple expansion, PEs rise, and then vice versa, when obviously rates are rising, you get that reverse. And I think, investors, particularly investors overseas and in the US, have had the benefit of interest rates going to very, very low levels. And, now potentially there is the sea change where rates are starting to rise, given that inflation expectations are starting to rise. And that has big implications for, the stocks that you should have in your portfolio, and specifically your duration of your fixed income assets.
Thanks, Ed. In terms of where you see rates going forward into the new year?
Yes, I think we remain pretty convinced that interest rates are still too low. Real rates are still very, very negative. And that's in the face of an inflation curve and inflation expectations which continue to rise. So I think the transitory inflation argument is still being put forward, but it is becoming harder and harder, I think, for central banks to defend in the face of inflation, which is becoming more pervasive, specifically in the services sector of the economy. And that's stripping out, a lot of the sort of the goods side, which was also affected by the COVID shutdown and that sort of reopening trade. So I think, inflation looks as though it's going to go higher and stay higher for longer. And the question is, when do central banks actually act and start to pivot in terms of monetary policy? And it's interesting because many emerging markets have already started to push up rates. And you would have seen that we had a surprise rate increase. Some people were surprised last week, and or the last couple of days. And I think there's probably more of that to come.
Thanks, Ed. And then also during one of our Balanced Perspectives, I think in the second quarter, we just spoke about the ballooning government spending. I think the last 18 months has been unprecedented in history. I mean, going back to World War I and World War II. I'm most certainly going to get this quote wrong, but I think it was Roosevelt after World War II said something along the lines of wars cost money, which means taxes and bonds and taxes. So given how the fiscal account has just ballooned, or at least national spending from government as a portion of GDP has ballooned. Actually, South Africa is looking almost normal now, but pre-COVID we were looking quite worrying.
Yeah.
Surely the chickens must come home to roost at some point. I mean, is there a read-through in terms of how they might be looking to consolidate this budget post-COVID?
So I think globally, you're 100% right, is that governments supported economies with this huge fiscal stimulus, and the size of the stimulus was disproportionate to the impact of COVID. Certainly when we compare that to the GFC or the global financial crisis, we've had 4 times the size of stimulus, yet the economic impact of COVID has been only 25% of what the GFC was. So this is an enormous amount of stimulus that's been pushed into markets. It has supercharged the price of risk assets, and the low liquidity has really, or the very low interest rates and excess liquidity has lifted really all asset prices, including property. So I think that in terms of the debt levels now sits on governments' balance sheets, and ultimately there's only 3 ways to reduce that. I mean, the first is you repay it. And you do that via higher taxes, and there probably is some of that, and we're seeing the start of that in the US. Secondly, you can default. We think that that's probably unlikely. And then the third is you just have sustainedly higher inflation for 10 years or so. And I wouldn't be surprised that central bankers are sitting back and saying, well, if we have to choose between inflation, which is slightly higher or lower, given the debt burden, let's rather go with inflation that's sort of slightly higher, and maybe also talks to their dovish or reluctance to be preemptive in terms of pushing up rates even in the face of higher inflation. And if you think about it, if we have 2 to 3% inflation, you don't have to have hyperinflation, but 2 to 3% inflation over 10 years, and 30% of your debt is gone. So I think that's probably the way that this resolves itself. But you're right, the size of debt that governments have taken onto their balance sheets is enormous, and the ability for governments to print that money has never been as easy as it is now because of the pandemic. Whereas prior to COVID, for Europe to get through big deficits and support, you would have had, the there would have been fights, in terms of the Euro members. So I think COVID in a way has sort of enabled these big fiscal support packages to really be rolled out, and that's obviously benefited consumption, company profits, and then obviously asset prices at the end of the day.
I think I recall after or at least during the global financial crisis, I was living in UK at the time, and I remember reading some stunning number that the UK government's hand in the economy, or at least their contribution to GDP, as well as bailing out some of the private sector companies, was actually higher than I think the Russian communist governments was in their economy in the 70s, or at least 60s, 70s, and maybe even 80s. So quite stunning numbers. Also coming out of COP26 in terms of climate change, governments are going to have probably even more of an increasing role in terms of shaping their own economies.
Yep.
And just given some of those answers that you provided now, and not to sound too dire or down about things, because there is a lot of risk in the ecosystem currently going around. I mean, but with that also comes opportunity. So where have you and the team identified some of this opportunity, and is the time ripe to move on some of those?
So we think the first thing to be thinking about is some of the assets which really look expensive. So we would say, the returns over the next 3 to 5 years are yes, they're going to be shaped about what you own, but also about avoiding some of the really expensive long duration assets. And we think, when you look at bonds, global bonds, developed market bonds, they are really looking expensive. It's the one sure way that you can guarantee to lose money for your clients, because they're giving you a negative real return. So, that would be a space that we would say definitely want to avoid. And given that the sort of direction of travel for rates, we think for the US 10-year is probably north of 2%, you want to steer clear of some of the crowded, long duration, growthy equity trades. So all those shares where the growth expectations are fantastic and the hopes and dreams look amazing, and where they are trading on very, very high multiples. And those are the shares which will be more susceptible to a change in the discount rate, because they are more of the value lies into the future. Whereas where we're seeing more opportunity and where we think you'll get more protection is by focusing on those higher yielding, more value type names, where most of the value sits in the front end of your discounted cash flow model. So yes, if inflation is going to be higher for longer, you still have to have real assets. You have to be exposed to real assets because that's how we're going to protect ourselves. But we just think one should be starting to avoid some of those very crowded trades where the multiples look very expensive.
Excellent, thank you, Iain. Those are my 3 questions over for today, but I did reach out to some of my colleagues to ask you just quick fire, one-word answer style questions, and I'm also embarrassed to ask some of these, but I'm going to go ahead anyway. Who would you rather have on your investment committee, Elon Musk, Jeff Bezos, Mark Zuckerberg, or Jack Ma?
Probably Jack Ma. Yeah,
Okay.
I'll probably have Jack Ma. He sounds quite pragmatic. I think the others are great, but yeah, I think in terms of, I guess, valuation, I think, Jack is, he's been quite pragmatic. I like the fact that he's taken on the Chinese government. Yes, he hasn't succeeded. He's been ousted, but I think he's a guy who was visionary and who has built an enormous, I guess, empire and ecosystem that has, probably leapfrogged the way people in China consume compared to the rest of the world. So, I mean, I guess, the Chinese consumer is probably 10, 15 years ahead of where the rest of the world is in the way they engage with technology. And yeah, I mean, I think he's, I think he would be great. But I mean, all of those guys would be great, but I'd probably have Elon Musk last on my list.
I think going back to Jack Ma, I guess he comes with that sort of that Western notion of entrepreneurship, which we value and appreciate so much, but also with quite a decent understanding of the nuance of Chinese politics and how the system works there. And I'm sorry you mentioned Mr. Musk in that light, because my next question was, would you buy a Tesla?
A car? Would I buy the car?
Yeah, not the share, the car.
Yeah, no, I would definitely buy a car. In fact, I looked at one, but sadly they weren't available in South Africa at the time. But no, I do think that's where we're going, and I think all the OEMs, the car manufacturers, are changing their drivetrains, and as we know, there's going to be a significant migration towards EVs, and I think the guy was visionary, and he really has done well in terms of Tesla. But from an investment perspective, we just don't think that that's an attractive opportunity, given all the good news that is baked into the share price.
And he just ran a poll to sell X amount of his shares, I think. Was it as much as 6% or so?
He did, to offload some shares.
Okay.
Yeah.
And then another question was actually more personal. Have you ever had an investment kind of role model in your career?
So there have been a few guys that I have followed, and I mean some of the obvious ones, would have been like Jeremy Grantham. He was sort of part of GMO. Warren Buffett, Charlie Munger. The other guy I quite liked was George Soros, the way he thought about things. So I think, in the investment space, you always have to be flexible and adaptable, and you've got to be pragmatic and have an open mind, because, we live in this world which is sort of an unstable equilibrium. And you mentioned the word fragile earlier, and I think that's exactly right. Is that the system is in equilibrium, but it's very fragile, and small things can tip that over. And I think to have that perspective, to have a sense of what those potential downsides look like, and those payoff profiles can obviously be very, very rewarding. And I think those individuals have managed to I guess steward their capital and their clients' capital through many years of storms successfully.
Yeah, thanks, Iain. And the last one before I let you off the hook, your ideal Christmas holiday, beach or mountain?
Geez. Okay, so I love skiing. I would love to go skiing. I haven't done that for a while, but I would probably say right now I'd love to go snorkeling.
Okay, so beach.
It would probably be beach. Yeah, I'm not like a beach, lying on the beach type of guy. I'm sort of like underwater most of the time, but right now I think the water would be good.
Okay, I think I love the mountains, so you're probably trying to avoid me on holiday, and so no personal offense taken. But yeah, thanks, Iain, again. We gave a lot of gratitude last month, but for all the work you've done this year, and of course everybody for dialing in over the course of the last 12 balanced perspectives that we've held here so far in 2021. And what may 2022 bring? The COVID pandemic moving to an endemic, will the Chinese kind of shock us with another policy shift? Will we see net zero climate ambitions actually start to take shape in the real world, both in private and government sector? And then last but not least, will myself and my NEG Group colleagues be actually going into the office for the first time in almost 2 years? So from myself and Iain, my NEG Group colleagues, have a fantastic December and holiday break, and we look forward to catching up with you in 2022. Take care.